The president said it would be foolish for the Fed to raise interest rates next week. Is he right?
No, of course he's wrong, as he's wrong about most things. You know, I don't know what he understands, but what is forgotten in a statement like that is the Fed is still on the monetary accelerator. The process that we've been witnessing since the end of 2015 is gradually taking your foot off the accelerator and into neutral. Then there's a question of whether you touch the brakes, but we're not up to that question yet. The Fed's not up to that question yet. And with the economy, what did Trump say? Moving like a rocket ship? It's an exaggeration, but the economy's very strong. We don't need the monetary accelerator depressed now.
Yeah, it's a little confusing. You can't have an economy moving like a rocket ship and then be surprised when the Federal Reserve is raising interest rates, Alan. The debate on Wall Street has really been not December. December's priced in. It's more than a 70% probability that they'll hike next week. It's what happens
Correct.
next. And there seems to be a lot of disagreement from economists and from the markets and from the Federal Reserve itself on how the path looks.
I think that's right. I mean, Chairman Powell the other day made much more news than he meant to, I think, when he said something to the effect is now we're getting very close to the bottom of the range of estimates of neutral. That range, if you look at the last dot plot, and we'll see the new one pretty soon, but in the last dot plot was 100 basis points wide, from 2.5 to 3.5. That's a big difference as monetary policy decisions go. But the point of it is, once we have the December rate hike, which will come, we're getting pretty close to that range, and it gets to be controversial whether the Fed should pause there, go up a little bit more, or what.
Alan, how about this argument that we got from Fisher yesterday, Marty Feldstein in the Journal a couple of weeks ago, that you need to get the nuts on the trees in order to harvest them when the winter comes. You need rates at a level where you can bring them down by an average of 500 basis points, as we tend to do in recessions.
The last part of your question is true. We tend to bring them down something more like 500 than 200 basis points, but there's no way that we're going to a 5% federal funds rate with a 2% inflation rate in the current economy. That would be a 3%, maybe a little more than 3% real rate, and that's just not in the cards. So, I mean, I understand the argument, and it is, by the way, why the Fed has been a little bit more eager, or maybe a lot more eager, to normalize the interest rate than to normalize the balance sheet. They took the attitude the balance sheet can wait. Let's get the federal funds rate up to a point where we can lower it substantially if we need to. But that lowering, if and when it comes because of a recession or fears of a recession, I think is much more likely to be coming from an interest rate that looks more like 3 than like 5.
So what is actually going on with the economy, Alan? Things look all right if you look at the unemployment rate and even the pickup in wages that we've seen recently, but there are certainly some underlying signs that confidence is cooling, business investment is cooling, and clearly the market is trying to tell us something. What is it?
Well, you know, markets always exaggerate whatever they see, so I think if you're looking for shreds of pessimism in the current economy, you can find them here and there. You didn't mention housing. That's the weakest part of the economy right now. But there's a tremendous strength in the economy, and the level of the economy with a 3.7% unemployment rate is, I think, by almost anybody's guess, beyond full employment, beyond normal full employment. Remember, full employment doesn't mean every single person has a job. Even in World War II, the unemployment rate got down to, I don't know, 1 or 1.25%. But so the unemployment rate is very, very low, and that's a reasonable indicator of the tightness of labor markets and of markets in general. So, you know, if we should slow down a little bit from the unsustainably rapid pace that we've had in recent quarters, that's far from catastrophic.
Alan,
and far from a recession, by the way.
Right. I'm curious to know what you're thinking these days about the wealth effect. People have been tossing around charts of the percentage of household net worth to disposable income. And I mean, the argument is that if you do get a big downdraft in asset prices, it will weigh heavier on spending intentions than they have in the past. True or not?
Well, Yeah, I don't know about that last part, but it will weigh on investment spending and especially consumption spending to some extent. So a real crash of the stock market will have some effect. We've seen this in the past, and by the way, when it happened in very large magnitude in around the year 2000, 2001, it had a depressing effect on the economy, but let's remember a pretty small one, remarkably small. I call the little recession that we had after that the recessionette because it was so small. But there is a wealth effect, and of declining asset prices as they come will be pulling down consumer spending a bit. I think it's easy to exaggerate that. It's also easy to forget that the losses in the stock market that we've had of late basically have just wiped out 2018 gains. We're pretty close to flat on year 2018 right now. So as stock market years go, that's not that unusual. Stock market's very volatile. A 0 year is a bad year, that's for sure, but it's not a calamity.
Finally, Alan, wanted to ask you about the global economy because the U.S. is in relatively good shape. If you look, for instance, at Europe, some of the political instability with Brexit, the riots in France, the political uncertainty even in Germany, China slowing down. How insulated are we really to all of this, and how's the Fed going to think about that?
Yeah, it's a very good question. Certainly not completely insulated. I mean, we do interact with the rest of the world financially and in trade, of course. So exports are about 13, 14, I haven't looked recently, something like that % of GDP, and exports will suffer as the world slows down. And that looks to be happening a bit. I don't want to exaggerate it. I don't think anybody should exaggerate it, but China looks to be slowing a bit, but they're not going to slow a lot because the Chinese won't allow it to happen. There are these dangers in Europe, so I think there are real warning signs now going up in Paris and London and places like that, and Rome, by the way.